Spanish banks' loan relief is only likely to be temporary. On Tuesday, the European Court of Justice made a ruling in which they said that it was up to local Spanish judges to decide if Spanish banks had missold a bunch of mortgages to their customers. This ruling meant that Spanish banks would not have to pay billions of euros, potentially, in upfront compensation. Now, it's temporary for a couple of reasons. Firstly, they still face a big estimated liability. Some analysts estimate up to around 4 billion euros. But the fact that it's going to be on a case-by-case basis decided in local courts means that even if they do face that liability, it'll be spread out over a number of years. The other thing is, the loans they're making, i.e. these same mortgages, are set to become less profitable. That's because investors are betting that due to the coronavirus effect in Europe and the economic slowdown, the European Central Bank is going to cut interest rates. Now, most Spanish mortgage loans are tied to what's called the Euribor interest rate. If that falls, mortgages, i.e. borrowers, are going to pay less, which means that Spanish banks make less money off their mortgages. This is a big problem. They have two methods to try and offset this. The first is to cut expenses, but Spanish banks are already pretty efficient by European standards. The other method is to make up the decrease in profitability by increasing their volumes. But the fact is that Spanish loan volumes are already falling. And given the coronavirus and general slowing economic growth, that's not expected to pick up anytime soon. So it's great that Spanish banks had this ruling, but they still face a whole host of profitability challenges in the near future.